The human problem with time is a fundamental conflict at the heart of investing, and it has nothing to do with markets, prices, or money. It is a conflict between human nature and the passage of time. Benjamin Graham understood this conflict deeply, long before algorithms, high-frequency trading, or 24-hour financial news. He understood that the greatest challenge investors face is not finding good opportunities, but enduring the waiting that good opportunities require. Human beings are not built for long timelines. Our instincts evolved for immediate feedback. We are wired to respond to danger quickly, to seize opportunities fast, and to resolve uncertainty as soon as possible. In everyday life, these instincts are useful in investing. They are destructive. The market, by its very design, exposes this weakness. Prices move constantly, numbers change every second, gains and losses appear immediately on screens. The brain interprets these movements as signals demanding action. Something is happening, so something must be done. This feeling is powerful, persuasive, and almost always wrong. Benjamin Graham believed that the market's greatest trick was convincing investors that short-term movement mattered more than long-term value. To understand why long-term thinking is so difficult, we must first understand why short-term thinking feels so natural. Imagine a typical investor at the beginning of their journey. They open an account, they deposit money, they buy their first investment. At that moment, something subtle changes. Their attention shifts. They begin checking prices. At first, it is curiosity. Then it becomes habit. Soon, it becomes routine. Every price movement triggers emotion. A small gain creates satisfaction. A small loss creates discomfort. The investor begins associating self-worth with daily results. Without realizing it, they have allowed the market to become a judge of intelligence, competence, and even identity. Benjamin Graham warned against this psychological trap. He believed the market was not a reliable judge of anything in the short term, least of all investor ability, yet most investors allow it to dominate their emotional state. The problem is not that markets move. The problem is that investors watch. Short-term price movements are not reflections of value. They are reflections of opinion. Millions of participants vote every day, influenced by fear, optimism, headlines, rumors, and expectations. These votes change constantly. Value does not. A long-term perspective begins with accepting that most market activity is noise, and noise is seductive. It feels informative. It feels urgent. It feels actionable. Graham understood that resisting noise requires conscious effort, because noise speaks directly to emotion. This is why long-term investing feels unnatural. It requires overriding instinct. Graham often spoke about the difference between intelligence and temperament. Intelligence helps investors analyze information. Temperament determines whether they can act correctly on that analysis. Long-term investing is fundamentally a test of temperament. Most investors do not fail because they misunderstand value. They fail because they cannot wait for value to be recognized. Waiting is uncomfortable because it removes feedback. In the short term, there is no confirmation that a decision was correct. Prices may move against the investors. Silence replaces validation. Doubt fills the gap. Human psychology hates this condition. When outcomes are delayed, confidence erodes. When results are invisible, imagination fills the space with fear. Graham recognized this and designed his philosophy around it. He did not try to eliminate emotion. He tried to structure investing so emotion would do less harm. To Graham, the long term was not simply a time horizon, it was a protective barrier between the investor and their own impulses. Consider how people behave outside investing. If someone plants a tree, they do not dig it up every week to check if it is growing. They understand that growth happens invisibly, beneath the surface. Over long periods, investing is no different, yet people treat it very differently. Why? Because money carries emotional weight. Money represents security, status, freedom, and fear. When money is involved, patience feels risky, waiting feels like exposure, doing nothing feels irresponsible. The market exploits this feeling constantly. Financial media reinforces it. News channels speak in urgent tones. Headlines are designed to provoke reaction. Analysts predict outcomes with confidence. Charts are shown with dramatic emphasis. All of it sends the same message: act now. Benjamin Graham rejected this environment entirely. He believed that the investor who consumes too much market commentary inevitably loses perspective. Information does not equal insight, activity does. Not equal progress. A long-term perspective requires a deliberate withdrawal from constant stimulation. This does not mean ignoring reality. It means filtering reality. Graham encouraged investors to focus on fundamentals, not fluctuations. Fundamentals change slowly. They do not demand daily attention, they reward patience. Short-term price movements, by contrast, change constantly and reward reaction. They create delusion of opportunity while quietly increasing risk. One of Graham's most important ideas was that the market should be treated as a servant, not a guide. The market exists to offer prices. It does not exist to offer advice. Yet most investors invert this relationship. They allow prices to guide decisions, emotions, and confidence. A long-term investor reverses this dynamic. They decide what something is worth first. Then they wait for the market to offer a price. That makes sense. Time becomes an ally rather than an enemy, but this approach requires something most people underestimate: emotional endurance. Imagine holding an investment that goes nowhere for years. No excitement, no headlines, no praise. Others boast of faster gains. New trends emerge. Doubt creeps in quietly. This is the real test of long-term thinking. Graham understood that boredom is more dangerous than fear. Fear at least signals danger. Boredom erodes conviction slowly and invisibly. Investors abandon sound strategies not during crashes, but during long periods of stagnation. They ask themselves why they are waiting. They begin to believe they are missing something. Eventually, they act not because the decision is wrong, but because waiting has become unbearable. The long-term perspective reframes waiting. It turns waiting into strategy. It recognizes that value does not need to be hurried. It allows investors to accept that being early often looks like being wrong. Graham believed that the investor who cannot tolerate being temporarily wrong will never achieve long-term success. This idea is deeply uncomfortable. Modern culture celebrates speed, quick results, immediate feedback. Investing rewards the opposite. Long-term investing demands humility. It requires accepting that markets will not reward you on your schedule. It requires trusting analysis over emotion. It requires the strength to do nothing while others do something. Time reveals character in investing. Short-term thinking often masquerades as intelligence. Rapid decisions feel smart. Constant adjustments feel sophisticated. In reality, they often indicate insecurity. Long-term thinking looks passive from the outside, but it is internally demanding. It requires continuous restraint. It requires resisting the urge to respond to every stimulus. It requires confidence without confirmation. Benjamin Graham designed his philosophy to help investors survive this psychological strain. He emphasized diversification to reduce emotional pressure. He emphasized margin of safety to reduce regret. He emphasized long-term thinking to reduce error. At its core, Graham's philosophy acknowledges a simple truth: markets test patience before they reward it. Those who cannot endure the test never reach the reward. As this discussion continues, one thing will become increasingly clear: the long-term perspective is not about optimism. It is about realism. It is not about believing markets will always go up. It is about believing that value, given time, tends to assert itself. Time does not eliminate risk, it redistributes it. Short-term investors face constant emotional risk. Long-term investors face temporary uncertainty in exchange for structural advantage. This trade-off defines investing. Benjamin Graham and the discovery of patience. Benjamin Graham did not arrive at his philosophy through theory alone. He arrived at it through experience, loss, observation, and time. His belief in long-term thinking was not academic. It was earned. To understand why Graham placed such importance on patience, one must understand the environment in which his ideas were formed. He lived through periods of extreme market optimism and devastating collapse. He saw what impatience did to intelligent people. He saw how emotion erased logic. And most importantly, he saw how time exposed both mistakes and wisdom with brutal honesty. Graham began his career in an era when markets were already volatile, but they were nothing compared to what he would later witness. Early in his life, investing still carried an air of seriousness. Speculation existed, but it had not yet consumed the culture. Investors spoke of balance sheets, earnings, and assets. But beneath this surface, impatience was already present. As Graham studied markets. He noticed a troubling pattern. Prices moved faster than businesses, opinions shifted faster than facts, and investors responded not to value, but to momentum. He began to understand that the market had its own personality, one that changed moods frequently and often irrationally. This realization would later become one of his most famous metaphors, but at the time, it was simply an observation. The market behaved like a person with emotional swings, sometimes optimistic, sometimes depressed, often inconsistent. The challenge was not predicting this behavior, but learning how to respond to it. Then came the events that would define his thinking forever. The great market collapse was not a single moment. It was a process. Prices fell, recovered slightly, and then fell again. Confidence eroded gradually, then suddenly disappeared. Investors who had felt invincible only months earlier were paralyzed by fear. Graham watched. Intelligent, well-educated people abandoned reason entirely. He saw investors sell valuable assets at desperate prices simply to escape uncertainty. He saw others cling to worthless positions because they could not accept loss. The market did not simply destroy wealth, it exposed human weakness. For Graham, this period was transformative. He realized that the problem was not lack of information. Investors had access to data. The problem was time perspective. When people thought short-term, they reacted emotionally. When they reacted emotionally, they made irreversible mistakes. The collapse taught Graham a lesson that would remain central to his philosophy. Short-term thinking turns temporary problems into permanent losses. During the panic, businesses did not suddenly become worthless. Factories still existed. Customers still bought goods. Employees still worked. Yet prices collapsed as if value had vanished entirely. This disconnect revealed a powerful truth. Markets could be wrong, not occasionally, but dramatically. And if markets could be wrong, then reacting quickly to market movements was not intelligent, it was dangerous. Graham began to see patience not as a passive trait, but as a form of defense. Time allowed fear to subside. Time allowed facts to reassert themselves. Time separated those who survived from those who surrendered. He observed something else as well. The investors who recovered were not the ones who made clever trades. They were the ones who did not panic. They held onto quality assets. They waited. They endured discomfort. And when markets stabilized, they were still standing. This experience cemented Graham's belief that the primary enemy of the investor is not the market, but their own reaction to it. Short-term thinking magnified fear. Long-term thinking absorbed it. As markets eventually stabilized, Graham noticed that prices slowly began to reflect reality again. Businesses that had been priced for disaster recovered. Those with strong fundamentals survived. Those without substance disappeared. Time did what emotion could not. It sorted truth from illusion. This sorting process fascinated Graham. He realized that markets were not efficient in the short run. They were emotional. But over long periods, they were remarkably honest. Value emerged. Weakness was exposed. Reality prevailed. This insight became foundational. Graham understood that investing should be structured around this process. Instead of trying to predict short-term movements, investors should align themselves with long-term outcomes. Instead of reacting to fear, they should prepare for it. Patience became the central requirement. But Graham did not romanticize patience. He understood how difficult it was. He knew that waiting without reassurance tested confidence. He knew that enduring periods of underperformance felt like failure. He knew that social pressure intensified doubt. This is why his philosophy emphasized structure. He did not simply tell investors to wait. He gave them tools to help them wait. Margin of safety, reduced regret, diversification, reduced anxiety, conservative assumptions, reduced disappointment. All of these tools served one purpose: allowing investors to hold through uncertainty. Graham believed that patience without structure collapses under pressure. Another lesson Graham learned during turbulent periods was that time exposes character. Investors who claimed to be long-term revealed their true nature during downturns. Many who spoke confidently about holding through volatility sold at the worst moments. Others who remained quiet endured. Graham noted that long-term thinking is easy to claim and difficult to practice. It only reveals itself when tested. This realization made him skeptical of strategies that depended on constant action. He observed that frequent decision-making increased the chance of error. Each decision created an opportunity for emotion to interfere. Over time, these errors compounded negatively. Long-term investing reduced decision frequency. Fewer decisions meant fewer emotional mistakes. Graham came to believe that investment success is more about avoiding errors than achieving brilliance. Time helps avoid errors by discouraging unnecessary action. He also observed that the market punishes impatience asymmetrically. Those who panic sell often do so at the worst possible moment. Those who chase trends often buy at inflated prices. The cost of impatience is not evenly distributed, it is concentrated, and severe patience, by contrast, offers asymmetric protection. It does not guarantee gains, but it reduces catastrophic loss. It increases the probability of satisfactory outcomes. This asymmetry appealed deeply to Graham. He was not interested in maximizing upside at the expense of stability. He was interested in building strategies that survived uncertainty. Time was essential to this goal. As Graham refined his philosophy, he became increasingly convinced that short-term success was irrelevant. Many investors enjoyed brief periods of outperformance, only to lose everything later. Graham viewed this as failure. True success, in his view, could only be measured over full cycles, and full cycles required time. This belief shaped how he taught, how he wrote, and how he advised investors. He consistently discouraged speculation disguised as investing. He warned against chasing trends. He emphasized long-term discipline over short-term excitement. Graham also recognized that markets would always tempt investors to abandon patience. New technologies, new industries, and new narratives would emerge, each promising rapid rewards. He did not dismiss innovation, but he warned against haste. He believed that time is the ultimate test of any idea. Ideas that survive time are sound. Ideas that collapse under time were flawed from the beginning. As markets recovered and evolved, Graham's confidence in this principle deepened. He watched successive generations repeat the same mistakes. Each believed their moment was unique. Each underestimated the power of patience. Graham's role, as he saw it, was not to predict markets, but to remind investors of enduring truths. One of those truths stood above all others. Time favors discipline, time punishes haste, time reveals value, and the investor who respects time aligns themselves with reality rather than illusion. By the end of his career, Graham had become known not just for his analytical rigor, but for his calm. He was not shaken by volatility. He did not chase excitement. He trusted process. That trust was built on experience. The markets to faces, short-term and long-term. As Benjamin Graham reflected on decades of market behavior, he began to notice that the market did not behave as a single, consistent entity. It behaved as if it had two personalities, each operating on a different timeline. One was loud, emotional, and impatient. The other was quiet, rational, and deliberate, understanding. This distinction became central to Graham's belief in long-term investing. In the short term, the market is driven by mood. Prices rise because people feel optimistic. Prices fall because people feel afraid. News, rumors, expectations, and narratives dominate behavior. In this environment, facts are often secondary. Emotion sets the pace. Graham described this short-term market as a voting machine. Every day, millions of participants cast votes not on value, but on opinion. These votes change constantly. A single headline can reverse sentiment. A rumor can inflate prices. Fear can erase years of progress in a matter of weeks. The short-term market does not ask whether a business is strong. It asks whether people feel confident. It does not ask whether earnings are sustainable. It asks whether expectations are rising or falling. In this environment, prices fluctuate wildly, often without any meaningful connection to reality. Most investors live entirely within this short-term market. They wake up to it. They monitor it throughout the day. They react to it emotionally. Their confidence rises and falls with it. Without realizing it, they allow the voting machine to define their experience. Graham believed this was a mistake. In the long term, the market behaves very differently over time. Emotion loses influence. Reality asserts itself. Businesses generate earnings or they do not. Assets produce value or they do not. Debt burdens become visible. Competitive advantages either endure or disappear. This long-term market, Graham explained, is a weighing machine. It weighs substance. It weighs performance. It weighs durability over long periods. These factors dominate outcomes. The weighing machine is slow. It does not respond to headlines. It does not react to daily price changes. It works quietly, often invisibly. Over years, investors who align themselves with this process must learn to wait. This waiting is uncomfortable because the weighing machine does not provide immediate feedback. While prices fluctuate daily, value changes gradually. Investors who focus on value must tolerate long stretches where prices do not reflect reality. Graham understood that this disconnect was the source of both opportunity and pain. Short-term thinkers experience this disconnect as frustration. They see prices moving against them and assume something is wrong. Long-term thinkers experience it as opportunity. They recognize that mispricing is inevitable when emotion dominates. The key difference lies in time perspective. An investor focused on the short term sees volatility as risk. An investor focused on the long term sees volatility as information. It reveals where emotion has distorted prices. It signals when patience may be rewarded. Graham believed that the investor's job was not to predict when the weighing machine would act, but to position themselves so that when it did, they would benefit. This positioning requires confidence. Without confirmation, consider how often markets misjudge reality in the short term. Companies with strong balance sheets are punished because of temporary setbacks. Entire industries are abandoned because of cyclical downturns. Conversely, weak businesses are rewarded because they fit a popular narrative. Graham watched these patterns repeat endlessly. He observed that investors consistently overreacted to short-term developments while underestimating long-term outcomes. This behavior created cycles of excess and despair. The long-term investor learns to step outside these cycles. Graham often warned that investors who focus too heavily on short-term price movements eventually lose the ability to think independently. They begin to outsource judgment to the market. When prices rise, they feel validated. When prices fall, they feel foolish. This dependence is dangerous. The market does not know the future. It does not know value in the short term. It reflects collective emotion. Treating it as a guide rather than a reference point leads investors into a reactive mindset. Long-term investing reverses this relationship. The investor forms an opinion based on analysis and allows the market time to converge toward reality. Prices are observed, not obeyed. This mental shift is subtle but profound. Graham emphasized that the market's short-term behavior should be viewed as a source of opportunity rather than instruction. When prices deviate from value, disciplined investors act. When prices reflect value, disciplined investors wait. Time is what allows this discipline to function. Without time, mispricing cannot correct. Without time, emotion does not dissipate. Without time, value remains hidden. This is why Graham viewed impatience as the investor's greatest liability. Impatience forces decisions before the weighing machine has time to operate. Short-term investors often demand immediate results. When they do not appear, they abandon sound positions. They sell undervalued assets because prices have not moved. They buy overvalued assets because prices are rising. In doing so, they align themselves with emotion rather than reality. Graham believed that markets reward patience not because patience predicts outcomes, but because patience allows outcomes to unfold. Another important implication of the market's two faces is that being right too early feels the same as being wrong. This insight is critical. An investor who buys a fundamentally strong asset at a favorable price may still experience losses in the short term. Prices may decline further, sentiment may worsen, critics may appear, doubt may intensify. Short-term thinkers interpret this as failure, long-term thinkers interpret it as delay. Graham believed that investors who cannot tolerate delay will never fully benefit from value investing. Delay is the price of mispricing. It is the cost paid for buying value before it is recognized. The weighing machine does not operate on schedules. It does not respond to expectations. It moves when reality becomes undeniable. This uncertainty about timing is what drives many investors back to speculation. They seek faster feedback. They chase momentum. They trade activity for certainty. Graham rejected this trade. He accepted uncertainty as the cost of discipline. He believed that aligning with long-term outcomes, even without knowing when they would occur, offered better odds than chasing short-term movements. Time in this sense, is not a guarantee. It is a probability enhancer the longer the horizon. The greater the influence of fundamentals, the shorter the horizon, the greater the influence of emotion. This principle shaped Graham's view of success. He did not measure success by quarterly performance. He measured it by durability. Strategies that failed under time pressure were flawed. Strategies that endured cycles were sound. Long-term thinking allowed investors to step away from the market's daily drama and focus on what truly mattered. It reduced emotional fatigue. It improved decision quality. It created consistency. Graham believed that most investors exhaust themselves trying to keep up with the market's short-term pace. They spend enormous energy reacting to fluctuations that ultimately mean very little. By the time value asserts itself, they are no longer positioned to benefit. The long-term investor conserves energy. They act selectively. They wait deliberately. They accept periods of inactivity. This restraint is not weakness, it is strength. As we move forward, it becomes clear that understanding the market's interfaces is not optional for serious investors. It is foundational. Without this understanding, patience feels pointless. With it, patience becomes rational. The illusion of control and the danger of short-term thinking. One of the most powerful forces shaping investor behavior is the desire for control. Human beings are deeply uncomfortable with uncertainty. When outcomes are unclear, the mind searches for ways to regain a sense of command. In investing, this instinct often manifests as activity: buying, selling, adjusting. Reacting these actions create the feeling that something is being managed, even when that feeling is false. Benjamin Graham recognized this instinct early in his career. He observed that investors were far more comfortable doing something, anything, rather than waiting. Even when waiting was the correct decision, it felt irresponsible. Action felt prudent. Inaction felt risky. This perception is one of the most dangerous illusions in investing. Short-term thinking feeds this illusion relentlessly. Price charts move constantly. News arrives endlessly. Opinions flood the air. Each update suggests that new information has emerged, that conditions have changed, that decisions must be revised. Investors begin to believe that constant adjustment is a sign of intelligence. Graham believed the opposite. He believed that most activity in markets is noise responding to noise. When investors react to short-term movement, they are not gaining control, they are surrendering it to emotion. The illusion of control is strongest when markets are active. During periods of high volatility, investors feel compelled to act because uncertainty is high, yet volatility does not increase the need for action, it increases the need for discipline. Graham saw that many investors confused motion with progress. They measured effort by frequency of decisions rather than quality of judgment. This confusion led to repeated mistakes. Consider how often investors revise decisions not because fundamentals have changed, but because prices have. A stock declines, and the investor assumes something must be wrong. A stock rises, and the investor assumes something must be right. In both cases, price movement replaces analysis. This is not control, it is reaction. Graham believed that the investor who allows prices to dictate decisions has abandoned independent thought. The market becomes the authority. The investor becomes a follower. Short-term thinking thrives in this environment because it promises certainty. It offers immediate feedback. A trade is made, and the result is visible instantly. Gains provide validation, losses provide urgency. Either way, the investor feels engaged. Long-term thinking removes this feedback loop. Decisions are made based on value, not immediate outcome. Confirmation may take years. This absence of feedback feels uncomfortable, even threatening. The illusion of control fills this gap by offering constant signals. Charts, indicators, forecasts, and predictions all serve the same psychological purpose. They reduce discomfort by offering the appearance of foresight. Graham was deeply skeptical of this appearance. He believed that the market's complexity far exceeded any individual's ability to predict short-term movements. He did not deny that patterns existed. He denied that they could be exploited consistently without exposing the investor to significant risk. Short-term thinking often rests on the belief that the investor can outmaneuver the market. That with enough information, enough speed, and enough attention, superior outcomes can be achieved. Graham saw this belief as fundamentally flawed. The market aggregates the actions of millions. Competing against it in the short term requires not only intelligence, but constant correctness. One error can erase many small gains. Over time, this requirement becomes unsustainable. Long-term investing avoids this trap entirely. It does not attempt to outguess the market's mood. It allows the market to fluctuate while the investor remains anchored to value. Graham often emphasized that the desire to feel in control leads investors to overestimate their skill and underestimate uncertainty. This combination is dangerous. It creates confidence without foundation. During periods of market optimism, this false confidence spreads quickly. Rising prices reinforce belief. Success is attributed to skill rather than favorable conditions. Investors increase risk exposure precisely when risk is highest. Short-term thinking accelerates this process. Rapid gains create urgency. Fear of missing out replaces caution. Activity increases. Control feels strongest at the peak, just before it disappears. Graham watched this cycle repeat many times. He saw intelligent people abandon restraint because recent success made restraint feel unnecessary. They believed they understood the market. They believed they were in control when conditions changed. They were unprepared. Long-term thinkers experience markets differently. They expect cycles. They anticipate reversals. They do not confuse favorable outcomes with permanent conditions. This expectation reduces the illusion of control. Graham believed that humility was essential in investing. Humility acknowledges uncertainty. It accepts that outcomes cannot be forced. It respects the limits of prediction. Short-term thinking rejects humility. It seeks dominance. It seeks certainty. It seeks control. Another reason that illusion of control is so seductive is that it reduces anxiety temporarily. When investors act, they feel relief, they feel engaged, they feel protected, but this relief is short-lived. Each action creates a new decision point. Each decision point creates new uncertainty. The cycle repeats. Anxiety returns, often stronger than before. Long-term investing breaks this cycle by reducing decision frequency. Fewer decisions mean fewer emotional triggers. Fewer triggers mean less anxiety. Graham understood that peace of mind is not a byproduct of success, it is a prerequisite for it. He believed that investors who are constantly stressed cannot think clearly. Their decisions become reactive. They chase relief rather than results. Short-term thinking amplifies stress. Long-term thinking absorbs it. This does not mean long-term investors are unaffected by market movements. It means they contextualize them differently. A decline is not a command to act. It is information to evaluate. The illusion of control also manifests in prediction. Investors often believe that forecasting markets gives them power. They listen to experts, follow models, and track indicators, hoping to reduce uncertainty. Graham believed this reliance was misplaced. He observed that even the most confident forecasts frequently failed. Markets surprised experts repeatedly. What mattered was not prediction accuracy, but preparedness. Long-term investors prepare for uncertainty instead of trying to eliminate it. They diversify. They build margins of safety. They accept that outcomes will vary. Short-term investors attempt to avoid uncertainty by predicting it. This effort often increases risk rather than reducing it. Graham believed that this attempt to control markets often results in being controlled by them. The more investors react, the more they depend on short-term signals. The more they depend on signals, the less independent they become. This dependence is subtle. It develops gradually. Investors begin by checking prices occasionally. Over time, they check constantly. Each movement feels meaningful. Each fluctuation feels personal. The market becomes a source of emotional reward and punishment. Long-term investing deliberately weakens this relationship. It reduces exposure to constant feedback. It restores autonomy. Graham believed that autonomy was essential for rational decision-making. Investors who feel compelled to respond to every market movement are not autonomous. They are reactive. The illusion of control collapses during crises. When markets fall sharply, short-term strategies often fail simultaneously. Signals conflict, predictions collapse, activity increases, but clarity disappears. In these moments, investors realize how little control they truly had. Long-term investors enter crises differently. They expect volatility. They expect emotion. They expect disorder. Because of this, Expectation. They are less shocked. They are not scrambling for control, they are exercising patience. Graham believed that crises do not create weakness, they reveal it. Investors who relied on control through activity are exposed. Investors who relied on structure and patience endure. This is why Graham emphasized long-term thinking not as an optional strategy, but as a protective necessity. He believed that investors should design portfolios and processes that function. Even when control is lost, time is central to this design. Time allows recovery, time allows misjudgments to correct. Time allows discipline to prevail. Short-term thinking seeks control, long-term thinking accepts reality. This acceptance is not resignation, it is strategic clarity. Asterisk waiting. The most painful skill in investing. If there is one skill that separates long-term investors from everyone else, it is not analysis, intelligence, or access to information. It is the ability to wait. Benjamin Graham understood that waiting is not merely difficult, it is psychologically exhausting. It tests confidence, patience, and identity in ways that losses alone do not. Loss is immediate. Waiting is prolonged. Loss creates pain, but waiting creates doubt. And doubt is far more corrosive. When an investor buys an asset based on careful reasoning and sound fundamentals, there is often an unspoken expectation that results will follow within a reasonable time. This expectation is rarely acknowledged, but it exists. When time passes and nothing happens, the mind begins to question the original decision. Graham observed that investors are surprisingly tolerant of short-term losses if they believe recovery will be quick. What they struggle with is uncertainty without resolution. Waiting without feedback feels like standing still in a world that rewards movement. This is why waiting feels harder than losing. When prices fall sharply, investors experience fear, but they also experience clarity. The problem is obvious. The pain is visible. Action, even if misguided, feels justified. Waiting offers no such clarity. It presents silence, ambiguity, and unanswered questions. The market may do nothing for months or years. Prices drift sideways, news cycles change, attention shifts elsewhere. The investor is left alone with their decision, Benjamin Graham believed. This was the true test of conviction. Most investors underestimate how long value can remain unrecognized. They assume that if an asset is undervalued, the market will correct quickly. When correction does not occur, they begin to doubt the premise itself. This doubt is dangerous. It does not arrive suddenly, it accumulates slowly. Each day without movement adds a small weight to the mind. Over time, the weight becomes unbearable. Investors convince themselves that something must be wrong not with the market, but with their judgment. Graham understood that the market often delays gratification longer than investors can tolerate. This delay is not evidence that the investment thesis is wrong. It is evidence that markets move at their own pace. Waiting exposes investors to social pressure as well. While one investor waits patiently, others appear to profit quickly. Stories of fast gains circulate. New opportunities dominate conversation. Patience begins to feel outdated, even foolish. Graham recognized that envy is one of the most powerful forces undermining long-term discipline. Watching others succeed faster creates the illusion that patience is a mistake. But Graham also observed something critical. The success that arrives quickly often disappears just as fast. Short-term gains attract attention, but they rarely endure. Long-term gains attract little attention, but they compound quietly. Waiting filters outcomes. Many investors abandon sound strategies not because they fail, but because they work too slowly. This is one of the most tragic ironies in investing. The very trait that enables success, patience, feels like failure while it is being practiced. Graham believed that investors must be trained to reinterpret waiting. Waiting is not inactivity, it is commitment. It is the decision to allow value to surface rather than forcing outcomes prematurely. The investor who waits is not idle. They are holding a position of discipline against emotional pressure. Consider the experience of holding an investment through a long period of underperformance. Each month that passes without improvement increases psychological discomfort. Investors begin to imagine alternative decisions they could have made. They replay choices. They question assumptions. This mental activity creates emotional fatigue. Graham understood that fatigue erodes discipline more effectively than fear. Fear is acute. Fatigue is chronic. Short-term thinkers seek relief from fatigue through action. They sell not because selling is rational, but because waiting has become intolerable. They mistake relief for wisdom. Long-term thinkers learn to tolerate fatigue. This tolerance does not come naturally. It must be cultivated. Graham believed that investors should expect waiting to be uncomfortable. Expectation reduces surprise. Surprise amplifies emotion. By acknowledging discomfort in advance, investors are less likely to interpret it as a signal to act. Graham often emphasized that the market tests patience not randomly, but systematically. It delays reward, it challenges conviction, it creates long periods where nothing seems to work. These periods are not anomalies. They are essential components of the investing experience. Waiting also tests identity. Many investors define themselves by their ability to make good decisions. When those decisions do not produce visible results, identity is threatened. The investor begins to question not just the strategy, but themselves. This identity threat is subtle and powerful. Graham believed that investors must separate self-worth from short-term outcomes. Long-term investing requires emotional independence. The investor must believe in process rather than outcome. Waiting strengthens this independence. Another reason waiting is painful is that it removes stimulation. Modern markets provide constant engagement. Prices move, news updates, opinions change. Waiting deprives the investor of this stimulation. Silence replaces excitement. Graham understood that boredom is one of the most underestimated risks in investing. Boredom invites experimentation. It tempts investors to seek excitement elsewhere. This is why investors often abandon long-term strategies during calm markets, rather than volatile ones. When nothing happens, discipline weakens. Waiting requires structure. Graham did not expect investors to rely solely on willpower. He believed that willpower fails under sustained pressure. Instead, he emphasized systems that reduce temptation. Diversification, conservative assumptions, and long-term goals all serve to reinforce patience. He also believed that investors should limit how often they observe market prices. Constant observation magnifies emotional response. Reduced observation restores perspective. Waiting becomes easier when it is not constantly interrupted. Another crucial insight Graham developed was that waiting reveals whether an investment thesis is based on reason or hope. Hope demands quick confirmation. Reason accepts delay. Investors who secretly hope for rapid gains become impatient quickly. Investors who genuinely believe in underlying value are more tolerant of time. This distinction is critical. Graham warned against confusing optimism with analysis. Optimism fades under delay. Analysis endures. Waiting also exposes flawed expectations. Many investors believe that correct decisions should be rewarded immediately. When this does not happen, they assume error. Graham rejected this belief. He believed that correct decisions often appear incorrect for long periods. Markets do not validate intelligence on a schedule. They validate outcomes eventually. This eventuality is what long-term investors rely on. Waiting also plays a crucial role in risk management. Short-term investors often attempt to avoid discomfort by exiting positions early. In doing so, they convert temporary uncertainty into permanent outcomes. They lock in losses or abandon potential gains. Long-term investors accept temporary uncertainty to preserve optionality. They allow outcomes to develop. Graham believed that the greatest losses occur when investors abandon positions during periods of maximum discomfort. Waiting allows discomfort to peak and dissipate. Discomfort is not permanent. Value often is. Another important aspect of waiting is that it reduces decision frequency. Fewer decisions reduce opportunities for error. Each decision carries emotional and cognitive risk. Waiting minimizes exposure to these risks. Graham believed that investing success is often determined by what investors do not do. They do not react to every fluctuation. They do not chase every trend. They do not abandon discipline during quiet periods. Waiting is the thread that ties these behaviors together. Waiting also aligns investing with the natural pace of business. Businesses grow slowly. Competitive advantages develop over time. Strategic decisions take years to manifest in financial results. Short-term investors expect businesses to behave like markets. Long-term investors understand that markets should eventually reflect businesses. Waiting bridges this gap. Graham's emphasis on waiting was not idealistic. It was practical. He observed that investors who waited appropriately were more likely to benefit from recovery, revaluation, and compounding. Those who could not wait often exited at precisely the wrong time. Time does not reward impatience. It punishes it. Waiting also requires trust, not blind trust, but informed trust. Trust in analysis, trust in structure, trust in process. Graham believed that trust must be earned through conservative assumptions over confidence. Collapses under delay. Caution endures. This is why Graham insisted on margins of safety. They provide psychological comfort during waiting. They reduce fear. They strengthen conviction. Waiting without margin of safety is anxiety. Waiting with margin of safety is discipline. As investors wait, they often encounter another temptation: reinterpretation. They begin to adjust their reasoning to justify action. They reinterpret fundamentals pessimistically. They magnify risks. They downplay strengths. Graham warned against this behavior. He believed that reassessment should be objective, not emotional. Waiting does not mean ignoring new information. It means distinguishing between meaningful change and emotional discomfort. This distinction is critical. Waiting also teaches humility. It reminds investors that markets operate independently of their desires. It reinforces the reality that outcomes cannot be forced. Humility strengthens discipline. By the end of his career, Graham viewed waiting as the defining feature of intelligent investing. Analysis initiates decisions, waiting completes them. Without waiting, analysis is incomplete. As we move forward, the role of waiting will become even clearer when we explore compounding, the quiet force that only operates when time is uninterrupted. In the next part, we will examine how time transforms small advantages into lasting outcomes and why interference is the greatest enemy of growth. Compounding and the quiet power of time. Compounding is one of the most discussed concepts in investing. Yet it is also one of the least understood. Benjamin Graham understood that compounding does not impress in the short term. It does not announce itself. It does not provide excitement. It works silently, steadily, and only reveals its power after long periods of uninterrupted time. Most investors admire compounding in theory but sabotage it in practice. They interrupt it. They reset it. They abandon it before it can work. Graham believed that compounding rewards patience more reliably than intelligence. A brilliant decision held briefly produces little. A reasonable decision held for decades produces extraordinary results. Time is the essential ingredient. Compounding requires continuity. It depends on the ability to remain invested through periods of boredom, doubt, and discomfort. Each interruption weakens its effect. Each emotional decision breaks the chain. Graham observed that investors often underestimate how fragile compounding is. They believe that selling and re-entering later will not affect long-term outcomes. In reality, timing errors, taxes, transaction costs, and missed recovery periods quietly destroy the compounding process. The damage is rarely visible immediately. It accumulates slowly, invisibly, and irreversibly. This is why short-term thinking is so dangerous. It treats compounding as optional. It assumes that gains can be captured repeatedly without consequence. Graham rejected this assumption entirely. He understood that compounding is not forgiving. It does not pause. It does not wait for re-entry. It rewards continuity and punishes disruption. Time magnifies both discipline and error. An investor who allows compounding to operate uninterrupted benefits not only from growth, but from momentum. Each period builds upon the last. Returns generate additional capital, which generates additional returns. The process accelerates naturally. But this acceleration only becomes meaningful after many years. This delay is the reason most investors never experience true compounding. They abandon the process too early. They seek faster results. They mistake slow progress for failure. Graham believed that investors must learn to respect slow progress. Slow progress is not stagnation, it is accumulation. Compounding also changes the nature of risk over time. In the early stages, returns feel insignificant, small gains appear meaningless, but as time passes, those gains begin to dominate outcomes. The same percentage growth produces increasingly larger absolute results. This is why time matters more than timing. Short-term investors obsess over entry points. Long-term investors focus on duration. Graham believed that being approximately right for a long time was more powerful than being precisely right for a short time. Compounding also rewards consistency. Irregular behavior produces irregular outcomes. Frequent changes reset momentum. Long-term consistency allows gains to layer upon one another. Graham observed that investors who constantly adjust strategies rarely benefit from compounding. They are always starting over. Starting over feels harmless. In reality, it is costly. Each reset discards accumulated progress. Each reset delays maturity. Compounding does not care how intelligent the decision was, it only cares how long it remains intact. Time transforms modest advantages into meaningful outcomes. A small edge applied consistently over decades outperforms aggressive strategies applied briefly. Graham believed that the investor's true edge was not superior insight, but superior endurance. Compounding also teaches investors an important psychological lesson. Progress is uneven. Returns do not arrive smoothly. There are long periods where nothing seems to happen, followed by periods where growth accelerates rapidly. Investors who expect steady progress become discouraged during quiet periods. Investors who understand compounding remain patient. The long-term perspective allows investors to accept uneven progress as normal. Another subtle benefit of compounding is that it reduces dependence on new decisions. Once capital begins to grow meaningfully, the investor relies less on additional contributions or perfect choices. Time does more of the work. This reduces pressure. Reduced pressure improves judgment. Graham understood that pressure leads to mistakes. Compounding reduces pressure by shifting the burden from decision-making to patience. Compounding also rewards humility. It does not require constant brilliance. It does not reward ego. It rewards restraint. The investor who constantly seeks improvement often disrupts compounding. The investor who maintains a sound approach allows compounding to operate freely. Asterisk.